In the past few weeks, a trio of alleged banking frauds has shaken investors and renewed old fears about the fragility of the American financial system. What began as a few isolated losses became a broader story, a broader issue, one that's raising questions about whether the banking industry's problems are deeper than many want to admit. Two regional lenders, Zions Bancorp and Western Alliance Bancorp, recently disclosed that they had been hit by loan fraud connected to investment funds tied to Andrew Stupin and Gerald Marcel. Both banks said the funds borrowed money to finance the purchase of distressed commercial mortgage loans. But according to Zions, something went wrong. A lawsuit that was filed by its subsidiary, California Bank and Trust, revealed that roughly $60 million in loans were misused and that many of the underlying notes and properties were allegedly transferred to other entities without authorization. Stupin and Marcel's attorney insists that the allegations are false, they're unfounded, and that his clients will ultimately be vindicated. But that's not important. It was the bank's failure to monitor how the funds and the underlying assets were actually used. And that raises many questions. Now, compared to the recent collapses of Tricolor Holdings and First Brand Groups, these numbers might sound small. $60 million, that's change in terms of corporate finance. Tricolor, for example, that was a subprime auto lender, filed for bankruptcy last month, triggering near total losses on some of its debt. And the First Brands Group, an auto parts supplier, collapsed under more than $10 billion in liabilities owed to major Wall Street firms. Against that backdrop, a $50 million or a $60 million charge-off might seem like a rounding error. But the reaction in the markets told a very different story. It shows how fragile the financial system is and how susceptible U.S. regional banks are